China's e-commerce giants were more than ready for this year's Singles Day. They'd lined up 4,000 planes and ships, 3 million people, and an army of robots to handle orders for the world's biggest online shopping event.
Our original capacity was around 700,000 orders per hour. Since the new distribution machines were put into operation, we can handle 1.5 million pieces per hour.
The success of Singles Day demonstrates Alibaba's dominance in the market. It sells about a fifth of all Chinese consumer goods, compared to Amazon's 5% share of the US retail market. Beijing's taken notice. Last week, regulators suspended the IPO of Alibaba's financial technology affiliate Ant Group, citing major issues. The company had planned to raise $37 billion in what would have been the world's largest listing. And now, the government is cracking down on the whole industry with new antitrust laws.
The Chinese government is increasingly concerned, I guess, about the monopoly power that these companies can exert, which is interesting because it's very similar to what you're seeing in capitalist economies, or have seen in capitalist economies for years.
The new rules aim to stop anti-competitive practices like companies selling at a loss to eliminate rivals, the use of exclusivity clauses to prevent sellers from dealing with rivals, and the sharing of sensitive consumer data. The regulations have led to investors dumping Chinese stocks, with $280 billion in market value erased since Monday. The tech-heavy Hang Seng in Hong Kong lost 6.23% on Tuesday. Alibaba shares were down 10%, while rival JD.com lost more than 9%. China's rout follows similar slumps in global tech shares. That's after new antitrust charges against Amazon in Europe and news of a potential Pfizer COVID-19 vaccine that could put an end to work-from-home arrangements.
From an investor point of view, it basically means that nowhere is safe in the tech sector, whether it be Europe, the US, or now increasingly Asia.
For years, China's had a hands-off approach, allowing internet giants to branch out into entertainment, finance, and healthcare. Analysts say Beijing's new rules are a signal that in the years to come, regulations will be much more heavy-handed. Paolo Montecillo, TRT World.
Now let's bring in Vasuki Shastry in Washington, D.C. He's an associate fellow at Chatham House's Asia Pacific program and was previously the global head of public affairs at the International Monetary Fund and Standard Chartered Bank. Welcome to the program, Vasuki. Now, the Singles Day event may have netted Alibaba around $70 billion according to its latest figures, but this overhaul of China's tech sector is costing them a lot more, and it has cost other tech companies billions of dollars as well. Can you just explain to us what are these measures and why does the Chinese government think they're needed now?
Thanks for having me. One way of looking at this is China's regulators appear to have a love-hate relationship with these big tech firms. I mean, the love aspect of this is China needs to grow its digital economy, and the state-owned enterprises simply don't have the capability or the capacity to grow China's digital economy. Therefore, they need these big tech platforms because they have the market reach, they have the influence, and they certainly have shown in things in computer hardware as well as in e-commerce. They really have become world beaters. So one way of looking at the action against Ant Financial earlier in the week really is, I think China's regulators are saying, you big tech firms have become too big for your boots. We want to teach you a singular lesson. And the lesson really extends to three factors. I think the Chinese state-owned banks have grown really concerned about Ant Financial and WeChat Pay offering financial products. There's a great deal of concern about data protection and privacy. I think a lot of Chinese consumers, just like their counterparts in the US and elsewhere, are growing concerned about the sheer aggregation of consumer data by these big platforms. And then there's the aspect of monopolistic practices in e-commerce that is raising a lot of regulatory concern. So I think the Chinese authorities will figure out a path where these big tech firms will comply, and then they're going to move forward. I think they're not going to restrict their operations forever.
Now, as you say, authorities in places like the US and the EU are also grappling with similar issues in terms of its big tech firms. But are you worried that if and when these draft rules are implemented in China, might that have an adverse impact on innovation in China's tech sector?
I mean, I don't think so. I think Chinese regulators and the Chinese government really wants to position China at the heart of the Internet of tomorrow. So they want cutting edge AI, they want machine learning, they certainly want to maintain the leadership in hardware, and they want to maintain the leadership on e-commerce. And we've got to recognize that many of these big tech firms have a global footprint. So, Ant Financial has been expanding all over Southeast Asia. You obviously have TikTok, which has a massive footprint in the US. So Chinese regulators, like their counterparts in the West, are attempting to balance genuine concerns about monopolistic practices with the need to provide the space for these big firms to flourish. And I think there'll be a very Chinese way in which they find this delicate balance. It's going to be very different from the approach taken in other parts of the world. And I think one probable way they will do it is to essentially co-opt Alibaba, WeChat, and the other big tech firms to be part of part of China's planning for the Internet of tomorrow. I think they thought they had all of these people on board, but probably Jack Ma's intemperate comments last week probably put an end to, probably changed the regulator's mind.
Okay, well, let's see if these draft regulations do get implemented. Vasuki Shastry in Washington, thank you again for joining us.